Is Dave Ramsey's advice investment gold or a very slow path to getting ahead? We'll discuss that today. My name's Matt from Shoe Capital, where I talk about all things personal finance, investing, and business. So let's build a little context on who Dave Ramsey is. He's a real estate investor who had a lot of success early in his life. He made millions, but he used some very risky loan vehicles to secure his properties that could easily be called away at a moment's notice. So he was short millions and millions of dollars that he couldn't produce, and very slowly at first and then quickly lost all the real estate and wealth he built up over his whole life. This really scarred him in his experience, and as a result of that, he's created a very conservative investing approach and advice for all of his followers. It's extremely risk averse. He basically wants you to avoid all debt in your life, with the one exception of a short-term 15-year home mortgage that has at least 20% down. Basically wants you to live credit-free, so you have no credit cards, no loans of any kind, except that mortgage, and he wants to keep it very simple. Most people, he believes, don't have the discipline or the time or the consistency to live a good budgeted life, where if they have access to credit, that they're just going to spend it wildly and on frivolous things that they don't need, which may be good advice for some, but it really limits those who actually have some discipline and are willing to put in the work to try and use these tools to your advantage. It's a lot like using fire. You can use it to cook your food, you can use it to keep you warm, but if you don't know what you're doing with it, you can burn your house down or yourself. So here are my thoughts on that approach. When you avoid debt, it is two-edged. You're avoiding the good debt on potentially appreciating assets, and typically we think of real estate in this category, but you're avoiding that bad debt. So all those expenses that don't have any value or depreciate very quickly. Many out there think of clothing, experiences, and other things of that nature. Also, if you don't have credit in your life, you're going to limit your arbitrage opportunities. It's going to make you unable to get credit cards, which have some very lucrative sign-up bonuses, which can give you 0% interest for sometimes 12 or 15 months, as well as cash back on every purchase, and cash back sign-up bonuses that allow you to use spend you're already going to do every month, such as gasoline that most people have, and turn that into bonuses in your favor. So as long as you have the discipline to pay off your balance in full every month or at the end of that promotional period, so you don't accrue any interest, you're still coming out ahead. And not using credit is going to make it very difficult for you to get a mortgage. It can be done. You have to show a lot of proof, and you'll have to go with a very limited pool of banks, so you're ultimately probably going to pay a higher interest rate because they're not going to have that credit leverage. And that's why credit is so important in your life. It's really the leverage that your lenders have to decide if you're worth the risk. And people with good credit typically don't want to ruin their credit because it limits their future opportunities. So using that as the main factor to deciding if you're a worthy risk to a lender is why that's such an important factor going forward. Now, I do want to touch on, there is some psychological benefit of being debt-free. Certainly later in life, when you're not working, it can feel very satisfying to pay off your mortgage in full. And certainly you want to reduce any high interest debts you have that are certainly in the double digits. And I can see the benefit to that. And that's certainly a personal decision, whether you want to go that route. But just remember the opportunity cost you're making. We talk a lot in this channel about the long term, particularly the proven US stock market, which the largest stocks in that index have proven over the decades that they've produced 11.8% per year. So if you're paying off low interest rate debt, like a 30-year mortgage, which might be 3% or less, depending on when you picked one up in the past couple of years, you could be losing that spread in investment performance. And over the course of 10, 20, 30, 40 years, you could be losing millions of dollars in investment potential. So it's certainly something to think about. There's psychological benefits, for paying off your debt. But if you're disciplined and smart on how you use it, you can really set yourself up for success in the future. It could be the difference between renting for another 10 years or using an FHA low down payment loan to get into a home that over those 10 years, you could be more than a third of the way to fully owning it, in addition to enjoying the appreciation and other benefits on your taxes come filing time. So definitely consider these things. Thanks for listening. Hope this was helpful in your considerations on how to approach Dave Ramsey's advice, and whether you want to go the very conservative road or you want to try and use debt smartly to your favor. Please like and subscribe if this helps you, and I'll talk to you again soon. Thanks.